Hello and welcome to the Complete Professional Development Program Financial Wellness lesson on retirement planning. There are 6 key areas of financial planning and they're listed here on this slide, and today we'll only be specifically talking about the retirement planning portion of those. In building a solid retirement plan, it's important really to consider these 3 areas. Number 1 is calculating the cost. How much is retirement going to cost me? Number 2 is sources of income. What type of income will I have in retirement? And we'll talk a little bit about that, as well as the last phase, which is distributions. When I decide that I do want to take money in retirement, what is that going to look like? Where am I going to be pulling money from? So we'll be talking about those 3 key areas of building a retirement plan. And the first area we'll be looking at is calculating the cost. When calculating the cost of retirement, it's really critical that you, as you look into the future, and obviously it's a long way off to plan for retirement, but in doing so, it's really critical to look for a couple things. Number 1, you have to start with your monthly income in retirement, and you have to estimate, say, what type of income do I want? What do I want out of the future? What do I want it to look like? And then how do I kind of backlog it from there and build out building blocks and savings habits that will get me there to that level. So for instance, let's take a hypothetical example here. Let's say we've got a guy named Joe. Joe works at International Paper. He's 25. He recently graduated from the professional development program and recently graduated from University of Memphis Fogelman College of Business and Economics, and is a great student because he was in the complete professional development program. And so he has been working for International Paper for a couple years. He has $10,000 in savings, as it shows on the third line there. And he's talked with his financial advisor. He wants to have $10,000 a month, or about $120,000 income in retirement. And so the second thing that he looked at, well, I'm 25. When do I want to retire? When would be ideal number, ideal year? So he said, let's say I'm going to retire at 65 in 40 years. And as I said, he's a good saver, so he's built up about $10,000 savings and expects a rate of return of about 7%. 6 to 7% is normally a good figure to estimate for long-term purposes. And if you hit calculate, you'll see what comes out on the bottom there is about $2.1 million savings need. So that is what his total cost of retirement will be, is about $2.1 million. And his current savings, the $10,000 saved over those 40 years, earning 7%, will earn him will grow to about $149,000, almost $150,000. So that's what he's currently done. And then if you subtract the 149 from the 2.1 million, then he will need an additional savings of what he currently has of the 10,000. Need to save about 1.9, almost 2 million on top of that. So this is the first step in looking at, how do I get where I want to go in retirement, is calculating the cost. This is a good method. Now, granted, this is a basic financial calculator, and there's a couple things that aren't considered in the cost of retirement. And number 1 is cost of living, and cost of living increases. So normally inflation, you may have heard the term inflation or cost of living, that normally goes up about 3% every year. And because of that, the cost would grow higher, 3% higher year over year for the next 40 years, and then on into his retirement. So it's important to plan for that and have that in the illustration as well when you think about planning ahead like this. But this gives you a good baseline place to start. The second thing to look at when building a retirement plan is sources of income. So we've already talked about calculating the cost for Joe and what his situation would look like. So we know the cost is about $2.2 million. what we haven't looked at is sources of income. So Joe probably sat down and thought about this, and there's a couple of different areas of income that he'll have in retirement that he may have to build out, some that he may have, Social Security, for instance, but we'll dive into these areas of income and talk about this. As I'd mentioned a minute ago, Social Security is one of the biggest areas of retirement income that is provided by the federal government, but it's a program that was created under President FDR, Franklin Delano Roosevelt's presidency, and the bill was passed under his presidency, which it provides a lifetime income for retirees. So a portion of our paycheck is taken out for Social Security taxes, and then that money is held by the federal government. And then when we decide to retire later on in the future, then we can draw a monthly income for the rest of our life. And depending on when we decide to take it or when we decide to retire, we potentially could earn more or less based on how long we've worked, how much money we've made, and then how old we are when we decide to retire. So here's a basic chart of Social Security benefits and how it's kind of laid out year by year based on date of birth, based on full retirement age. The earliest you could take retirement at 62, they're in the third column. And then the last column to the right, the fourth column, is the benefits at age 70, which is the latest that you could take retirement. So if you look there, for people born in the years 1943 to 54, that top row, full retirement age for those people is 66. And if they were to take benefits as early as 62, then that benefit would be reduced by as much as 25%. So instead of receiving, say, $2,000, they would then receive $1,500 at 62. So it can be really beneficial the longer you wait, so that you can decide that you can earn more and decide to take more monthly income for the rest of your life as long as you're alive. So, and if you were to decide to wait beyond 66 to take Social Security, then you would be able to receive 132% more. So it can really be a huge benefit to wait if you're able to either work, if your health will allow you to work up to that point, or if you can draw on your own assets that you saved, so that you can make it to 70 and start earning some of that income. So there's different ways to design the plan based on Social Security, but this is kind of the chart that lays out the benefit amount, and as far as a percentage and full retirement age, and how it works. The second way to fund a retirement would be through personal retirement plans. And that can be done really a couple of different ways: through annuity contracts, through self-employment plans for business owners who they are self-employed and they want a retirement plan, but they don't have an employer-sponsored plan because they are the employer. And instead of having a personal retirement plan like an IRA, an individual retirement account, they could actually run the retirement plan or code the retirement plan through their business, so that they could contribute more to the plan compared to an IRA. So that's the second route. And then obviously the third route is an IRA itself, which people can contribute up to $6,000 a year for people like you and I who are under 50. Let's talk about annuity contracts. So annuity contracts is the first of the personal retirement plans. The way annuities work are there's really two phases in an annuity. Number one is the accumulation phase. Once you're building and growing your wealth up until the point where you decide to retire. Annuities are tax deferred, so they work similar to an IRA in that the taxes that you pay on the growth of the investment are avoided. So you're avoiding taxes in the growth phase year over year, which is a huge positive. There are specific withdrawal conditions. So if you have a bucket of money that you may need access to, annuities may not be the best route to do that because there are some conditions and clauses and penalties for taking money out before a surrender period. Normally, the surrender period that are written within annuity contracts, some are really between 7 and 10 years is the most common that I've seen. But so what that means is really you aren't really able to touch the majority of the money that's in the annuity until 7 years or 10 years down the road. But so that's how that works. Now, as far as contribution limits, there are no limits to the amount that you can contribute. So this is a huge upside on annuities, is that if you're building out a retirement plan and you know that you're going to make more money in the future, much more than you are now, then an annuity would be a really good route to take as opposed to an IRA, because you're limited on the amount that you can put into an IRA. Here in an annuity, you're not. The other avenue of a personal retirement plan would be a traditional IRA. There's also Roth IRAs, which we'll talk about here in a second, and kind of the differences there of those two. But traditional IRAs, the way those work they are available to anyone under age 70 and a half with earned income. Now, some of these numbers are a little bit old since the Secure Act under President Trump, that the law just came out as of 2020. So some of these rules have changed since these slides were written, but the contributions are tax deductible to an IRA as well. So meaning, let's take our friend Joe, for instance. We talked about him a few minutes ago. Joe is 25. Let's say he's making $50,000 a year at International Paper as a young adult, and he opens a traditional IRA. He contributes the max amount that he can, which is $6,000 a year. So he puts in $6,000, and the $6,000 he does contribute, he can deduct that off of his taxes. So instead of him being taxed on a taxable income of 50, he's now taxed on 44 compared to the 50, since he contributed the 6,000 into his IRA. So that's a benefit, a plus, a good feature of the traditional IRA. They also grow tax deferred. So meaning the $6,000 that Joe puts into the IRA, every year the growth of that investment year over year will not be taxed until he takes the money out in retirement. So at that point he will pay taxes, but he has seen 20, 30, 40 years of tax deferred growth. And then there's also mandatory distributions. You have to take a distribution at age 72, which that was one of the rules that had changed. Originally it was 70 and a half, now it's 72. So 72, when our friend Joe turns 72 years down the road, he'll have to take a distribution from a traditional IRA. And then there's also a catch-up contribution, meaning when Joe turns 50, he can now contribute an additional $1,000 per year on top of the 6. So instead of contributing 6,000, he's contributing 7,000. Roth IRAs are also a personal retirement plan that are built and are more common under young adults or young people such as you and I, who really are probably 50 or under, maybe 40 and under. But the differences between a Roth IRA and a traditional IRA, we just talked about a traditional for a few minutes. The Roth, the contributions that are contributed into a Roth IRA are not tax deductible, meaning our friend Joe, let's take him for example again. He makes $50,000. He contributes $6,000 into this Roth IRA because the contribution limits are the same, meaning he can only contribute $6,000 per year. That $6,000 that he does contribute is not deductible off his taxes, so he cannot pay taxes of only 44. He would pay taxes on the full income amount of 50,000. However, the Roth IRA, the growth of that $6,000 that our friend Joe contributes into the Roth account, that is also tax deferred, meaning from now until retirement he's not going to be taxed on the growth of that. Except the big difference between the Roth and the traditional is that when Joe does when he does decide to retire at whatever age that is, 60 or beyond, then the money that he takes out from that account, instead of paying taxes on that, that is now tax free to him. So he'll never pay a dime of taxes on the money that he puts into this account. So that's a huge, huge deal. There are no mandatory distributions since there are no taxes on it. The IRS claims that you do not have to pull money from this if you don't need to. And similarly to the traditional IRA, our friend Joe, when he turns 50, he can now contribute an additional $1,000 a year, meaning a full $7,000 up to that. At that point, he could contribute. So these are some of the foundational rules on a Roth IRA, and this is another one of the huge, most common retirement plans, personal retirement plans. Should you participate in a Roth or a traditional IRA? Which one? So I get this question quite a bit in my day-to-day work life, and it really depends on the situation. But as a general rule of thumb, I would say the younger you are, the more likely I would lean towards contributing to a Roth instead of a traditional, simply because you and I, being in our either late teens, early 20s, mid 20s maybe, being so young, we have basically the next 40 years to work. So we'll be working until we're 60, 65, somewhere along that line. So that's, at least 40 years. That's a lot of time that we'll be paying taxes on investments and growth and our income. And the sooner we can build tax-free savings compared to taxable savings, I would say that's definitely a big drawing point towards a Roth IRA. Now, there's certain situations where you may have an account with your employer where it's a traditional IRA or traditional 401k, which works similarly, and you have to pay taxes on that later on in life, in retirement. But for the most part, I would say definitely have Roth, but having a traditional balances some of that out as well. And we may talk about some of the different tax buckets here in a few minutes, but both are important for different reasons. A Roth would probably be more influential or more beneficial for someone as young as you and I in our phase of life. So on top of a traditional IRA, a Roth IRA, and annuities for personal retirement plans and business retirement plans, there's really other savings methods such as non-qualified investments, brokerage accounts, things like that, that would benefit and kind of supplement the retirement savings that you're doing. The third and final area of building a solid foundation for a retirement plan would be looking at distributions. And so let's take our friend Joe, for example. So he's already calculated the cost. He knows it's going to cost about $2.2 million. He's looked at his sources of income, where they will be coming from in retirement. So he's decided that, okay, my full retirement age is going to be 66 in taking Social Security. So I know I'm going to have income from Social Security, and then I'm going to have to save the rest, the additional amount of money that I need per month from my personal retirement plans. So he's done some analysis on those, and then finally he's going to be looking at the distributions amount and where he will be pulling that from, designing a plan based on taxes on how he should do that in a tax appropriate manner. So we talked about annuities a few minutes ago. We talked about the accumulation phase, and now we'll be talking about the payout phase. So in the life of an annuity, you grow your wealth in the accumulation phase. In the payout phase, it can really work a couple of different ways. The most common of which are annuitizing the annuity, meaning receiving, you talk to the annuity company talk to your advisor, and then the client, decides that they want to annuitize the annuity or take a monthly amount of income from that for the rest of their life. And so instead of just having the lump sum of money available to them, they then turn over the responsibility of paying the income to the insurance company who holds the annuity, and the insurance company then promises to them that they will receive a payment each month for the rest of their life. Another way that you could take a distribution from a retirement plan or from an annuity itself would be taking a lump sum. So instead of annuitizing the money, the annuity contract, you would be simply taking the amount that you've built up over the life of the annuity or the life of the account, and those savings are now accessible to you because they're outside of the penalty, surrender penalty time frame. So then you can now take a lump sum distribution if you wanted to. So that's a second way to fund your retirement income. Something to consider when looking at a lump sum distribution, meaning pulling all of the wealth that you've saved at one time instead of in increments. When doing that, it's important to look at the tax perspective, because especially inside a traditional IRA or a traditional 401k, which is the most common savings type here in America, because most employers have a 401k that they offer to employees. So when pulling a lump sum from that specific bucket, it's very, very important to look at the tax perspective, because you've saved all of these years over the life of your working career, and now you will be paying taxes on the money that you've saved, because the IRS requires that the Uncle Sam is always going to want to get their portion. And so if that affects your income in any way, which it could shoot your income bracket up another level if you decide to take a portion of money from a retirement plan on top of the money that you had made in that year when you retire. So it's important to craft a plan surrounding around that, and be intentional about that as well. Something that happens very commonly here in America within employer workplaces are indirect rollovers or trustee to trustee transfers. So the way those work, or what that is where, let's take our friend Joe for example. Again, he's working at International Paper. He is now he is now 60 years old, and he has worked there for 35 years as an employee, worked his way up the chain of command there, and is now an executive in the C-suite at International Paper. So over those years, he has built up this huge mass of wealth inside his 401k that International Paper gives to him, and they match a portion of contributions that he does. So he's built up enough for his retirement, and he then decides to retire, and at that point then he can decide to have a rollover of his money, meaning once he does retire, that bucket, he can no longer contribute to his account, his 401k there at work, because he no longer is employed there. And so he has an option to roll that over into an IRA or an individual retirement plan without paying taxes. So that's something that's very, very common in this day and age with people who are working at employers and then retire. Roth IRA conversions. This is another thing to consider when looking at retirement and taxes within retirement, what that may look like. And there's certain scenarios where this could be beneficial. The way that a Roth IRA conversion works is a client may have a traditional IRA account, which they have not paid taxes on any of the money that's inside the account, and then they may have a Roth IRA, which they have paid taxes on the front end when they did contribute into the account, and so they will pay taxes in retirement on the traditional, but they will not ever pay taxes on the Roth. So what many clients do is they say, well, this money that I have here in the traditional IRA, I would like to pay taxes on the growth and then dump that money into a Roth IRA, and that way any money that I'm saving from here on out is now tax free. That I won't ever pay taxes on the rest of my life. And so there's certain scenarios where that may be beneficial more than others, but this is something to consider as well when looking at retirement planning. Thank you so much for taking the time with me today to learn more about retirement planning as it relates to building a well-balanced financial life. I would love to hear from any and all of you, especially if you have any questions about the topics that we covered today or any other topic that you hear in the Complete Professional Development Program as it relates to financial planning. Again, would love to answer questions or simply just to connect with you. If you want to connect with me, you may do so at my email, which is jglenn@shoemakerfinancial.com, and that's SHOEMAKER financial.com. You can also connect with me. You can either call me or text me at my cell phone, which is 901-238-7800. And again, thank you so much for your time.